Hello, everyone. Today is Tuesday. It's already 11 p.m. So I'm going to talk about the case 6.69. So in this question, we were provided with some information. It's an income statement with sales. That's 240,000 units. And the dollar amount is 1.2 million. The cost of goods sold, 800,000. Gross profit, that's the difference, which is 400,000. So operating expenses, selling, admin together, $430,000. And you have an operating loss of 30,000. Okay. So note, this is the income statement, right? So this is not a CVP statement format, right? This is the income statement. We were also provided with the information that the cost behavior analysis indicates that 75% of the cost of goods sold, 75% of this is variable, and 42% of the selling expenses are variable. This 42% of this, and the 40% of the admin expenses are variable. So 40% of 150,000, those are variable, okay? So the first step, in order for us to perform the CVP analysis, remember, we have to classify all the costs into either variable or fixed, right? So that's the thing we have to do first. So let's first allocate these cost numbers to break them into variable cost and fixed cost. The good news is in the question, we were provided with the information of the percentage wise, right? So for cost of goods sold, 75% of 800,000 is variable. So that's 600,000. So the other 200,000, that's the fixed. Similar idea, 42% of 280, 58% of 280. Okay, so that's the two number. Admin, 40% of 150, that's 60, 60% of 150, that's 90, right? So then you figured out the total variable cost is 977,600. The fixed cost is 452,400, okay? So that's how we break all these expenses into either a variable cost or a fixed cost, right? Because only when we do this, we are able to use the CVP analysis. We can quickly calculate what is the variable cost per unit. Okay, so the total variable cost is 777,600, and the total amount of units, the sales is 240,000, right? So this information is provided here. The sales, 240,000 units. So I know the variable cost per unit, okay, the variable cost per unit, that is $3.24. And the selling price, I use the sales, 1.2 million divided by 240,000 is $5. So I know the selling price is $5. The variable cost is 3.24, okay? So my contribution margin is the difference, 5 minus 3.24, which is $1.76, okay? Contribution margin ratio, I use contribution margin per unit, 1.76, divided by the selling price, $5. I get 35.2%. Break-even point in sales dollars, you use fixed cost. That's this number, 452,400, right? That's the total fixed cost divided by contribution margin ratio, 35.2%, and that's 1.285227. This is the break-even sales, right? So in order to break even, you have to make a sales of over 1.2 million, right? And in this case, your sales is 1.2 million, That's why you are in a operating loss, right? The break-even point in units, you use total fixed cost divided by contribution margin per unit. So that's around 257,045 units. And in this case, you only sell for 240, right? So that's under the break-even units. So therefore, it's an operating loss. So that's A. For B, in the question, basically this fan has a plan. So in the question, we learned that so basically the variable cost we are going to spend 25 cents more per unit on battery raw materials, right? So when you spend 25 cents on battery raw materials, that's the variable cost, right? Because the raw materials are the variable cost. So your variable cost per unit will increase by 25 cents from 3.24 to 3.49, okay? But this will increase the sales, okay, by 25%. So the sales volume was 240,000 and it's going to be increased by 25%, 0 times 125%. So the units will be 300,000 units after the sales, okay, after the sales. So now with that, let's rework on this CVP for statement. Sales, 300,000 times the new selling price. Okay, the new selling price is 5.25. And the variable cost is 3.49. Your contribution margin is 528,000. Less the fixed cost 452,400. You have an operating income before tax of 75,600. Okay, so that's good. At least under this plan, you are making money. So what's the contribution margin ratio? Total fixed cost, contribution divided by sales. So 33.52%. Break-even point of sales, total fixed cost, the same number divided by 33.52%. So you have over $1.3 million break-even point of sales. Contribution margin per unit, that's the selling price minus the variable cost per unit, that's $1.76. Break-even point in units, total fixed cost divided by contribution margin per unit, you get 257 and 45 units. Okay, so this plan has no effect on the break-even point. So the break-even point in units is still the same number, 257,045, 257,045, the same number, okay, because the total fixed cost is the same and the contribution margin per unit is the same, okay. But your break-even point in sales will be higher because the selling price has increased from $5 to $5.25. Okay. So the operating income was in a loss. It was in a loss of, let's see, $30,000, right? But with this plan, I have this operating income to be a profitable income, 75,600. Okay. So, okay, that's this second. The third is a different plan. So in this plan, okay, basically they are increasing variable selling expenses to 59 cents. Okay. So they are increasing the variable selling expenses from to 59, right? So what the number was before? So for selling variable 117,600. So I need to figure out what's the by unit. So I use 117,600 divided by 240,000. That was the sales unit for this cost. So it was 49 cents. Okay. So now they want to increase these expenses to 59 cents, right? So they are increased by 10 cents. So the increase is from 49 to 59 by 10 cents. So therefore, your new variable cost would be also 10 cents higher, right? So that would be 3.24. That's your old variable cost per unit. Now it's 10 cents higher. So that's $3.34. Okay. And then we also know that the selling price is lowered by 25 cents from $5 to $4.75. And the fixed cost will increase by 40,000. Okay. So the fixed cost used to be 452,400. Now we're going to increase this by 40,000. So now the new fixed cost is 492,400. And the sales volume will increase by 60%. So it was 240,000 and times 160,100. So I get 384,000. That's the new sales volume. So again, let's do this format. CVP, so the units, 384,000 times selling price, 4.75. Variable cost, the variable cost per unit is 3.3534. So your contribution margin is 441,440. Fixed cost is higher, 492,400. Your operating income before tax is 49,40. Okay. So contribution margin ratio. So that's contribution margin 541,440 divided by the sales. So we get 29.68%. And I use the total fixed cost divided by this contribution margin ratio. I get the break-even point in dollars of sales is over 1.6 million. Contribution margin per unit. So that would be the selling price minus the variable cost per unit, $1.41. And the break-even point, total fixed cost divided by contribution margin per unit. So I have 349,220. Okay. So now this is number C. So D, let's compare all this together. Okay, let's compare all this together. So we have 3 plans, the current plan. Okay, and plan 1 and plan 2, the dollars of the sales, okay, and the number of the units, okay, of the sales and the operating income, right? So when you compare this, well, you want to have higher operating income, right? So that's this number, 75,600. You also want to have a lower break-even point in units, right? So then these 2 are lower and this one is higher. So we are saying basically this plan in the middle is the best, right? You have the lowest unit break-even points in the units. You also have the highest operating income. Okay, so that's all for this question.